started. Let's start with the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Approval of minutes. We've got the minutes from June 28th. Do I have a motion?
So moved.
Second.
I've got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. And I forgot roll call. Could you do a roll call?
Yes.
I always forget roll call.
Commissioner Blaney,
Present.
Commissioner Good,
Oh, thank you.
Commissioner Biggs, Councilmembers Rivas,
Here.
Councilmember Graham. Here. Councilmember Jessen,
Here.
Councilmember Brickner,
Here.
Councilmember Wagner,
Here.
Councilmember Sims,
Present.
Councilmember Bozak,
Present.
and no advisory board members. So we do have a quorum.
All right. First thing is under new business. We've got our capital cities presentation. Corey, do you want to take it?
Yeah, thank you. As a reminder, I'm Corey Waddell from Capital Cities. I'm joined by Amanda Black today as well. You'll direct your attention right inside our packet here to the considerations and observations. It'll be the second slide there in the PDF. So our special project, after I'll cover performance and evaluation today, is an educational item on alternatives. If you'll recall from our meeting in May, we did a rehash of the updated risk return expectations to the portfolio, and we also previewed some recent research we've been doing in alternatives and wanted to relay that onto the board. So we will have that after the performance and evaluation. So I will flip into page 1 to set the stage for the markets for the second quarter, and then I'll provide an update of where the foundation sat as of the end of June 30th, and then I'll also bring you more up to date as of yesterday's close as well. So on page 1, I'm sure if most of you have been paying attention to the markets, or really any news, you've realized it's been kind of a volatile, choppy market to begin 2022. There's been a couple real big headwinds that are causing the challenging market. I think the first one that everyone's aware of is the inflation story that continues to persist into 2022. We saw some of the highest CPI prints in the second quarter that we'd seen since the early 80s, hitting into the 8 and 9%. And so that's continued to be a headwind for investors. Alongside that, combating the inflation story, central banks across the globe have to make money tighter or raise interest rates. And so that's also been a headwind for investors. We continue to watch what the Fed is saying at every meeting they come out with. And, we're in the midst of the rate hike season. We're not through their plans, and, more are telegraphed along the way. So it's definitely a position where we're continuing to digest the information coming out of the Fed as it relates to the interest rate environment. The other story, obviously, is the continued geopolitical concerns in Eastern Europe. Those are continuing to cause strains on the rest of the market as well as it relates to things like oil prices, commodity prices, so on and so forth. And so, the story really for the second quarter was there was nowhere really to hide in terms of investments, whether it was equity or fixed income. Just to give you some broad figures in the middle of the page, the equity returns are there in the middle. The blue bars, as you'll remember, are the last quarter, where the 12-month return are the gray bars. So the large cap core on the very left, that's the S&P 500, just to give you a good example of just broad U.S. stocks, down 16% for the 1 quarter time period. And now the trailing 1 year is negative 10%. So even those strong quarters that we had at the end of 2021 have been erased by the challenging performance of 2022. Really nowhere you could have, again, been safe within equity investments, but we did see some themes start to play out. We had been at the end of a really strong growth market for several years. We've seen that sort of flip, and value has held up better in this environment than growth. That's what we would expect, so that's been nice to see. Your value-based managers within your portfolio have held up better, so that's also nice to see that they're performing as expected. The bottom of the page, switching gears and focusing on fixed income. Really, the story here has been interest rates continue to rise, and when we see interest rates rising, the current bonds or fixed income in the market gets repriced downwards. So we see some temporary negative performance within fixed income when we see those types of time periods. Our broad proxy is the fourth column over. It's the aggregate index. And so this is just a broad proxy of U.S. government and corporate debt. The Bloomberg index was down 4.7% for the 1 quarter time period. And now over the 1 year time period, that's negative 10.3%. So really an anomalous 1 year time period for fixed income investors, being that we were at a 0% Fed fund rate, really coming off of the COVID shock. And now we've really sharply risen up to now the Fed fund rate's north of 2. And so that volatility within interest rates has caused the lion's share of this negative performance. So looking at page 2, how the foundation account held up in the second quarter. You look at the middle of the page there, the total portfolio ended the period $161,728,434. And then if you look at the far right, you can see the performance for the quarter and the trailing 12 month. Now with 55% strategically allocated to the equity markets, and unfortunately the 45% within fixed income not providing a ballast right now, we did experience that negative 9.7% quarterly return, and then the trailing 1 year number is now negative 12.1%. I will show you on the next page that both of those numbers are relatively good, holding up to your passively blended benchmark. So we have seen some outperformance by some of your active investment managers, namely, again, those value-based equity managers have held up better, and then some of your select fixed income managers have navigated the landscape better as well. But unfortunately, there's just, again, been nowhere to hide so far in 2022. I do want to bring you more up to speed and give you some more current data since we're almost to September now. As of yesterday's close, the portfolio sat at $171,799,000. So that represents a positive 6.2% gain from July 1 through August so far. And that brings our year-to-date numbers, so Jan 1 through August, into the negative 9% range. So we definitely have not clawed ourselves out of the woods here in terms of all of the losses for 2022. But so far, the first few weeks of the third quarter have been positive. On the bottom of the page there, we really don't have any changes to any of the manager stoplights as it relates to their performance. Again, the managers have been performing as expected. It's just been a very volatile market. And then page 4 is that relative performance I wanted to hit on real quickly. And so on the top page, on the top chart there, your total portfolio, it's the 6th row there. You can see the quarter return at negative 9.67, and then the evaluation benchmark directly below it. That evaluation benchmark is just a passively constructed index of your strategic allocation. So 55% equity and 45% fixed income. It should be what your bogey is for your managers. And you can see we did hold up better so far this quarter. Year to date, we have almost 1% of alpha on the benchmark, and then as you look longer time periods, you can see the outpacing of the benchmark as well. So with that said, it's never great delivering negative performance in these time periods, but this is definitely when you have to hold on as investors, trust the plan that you've put in place with a strategic asset allocation. The one thing that we're continuing to do on your behalf every day is checking in on the weights in terms of your portfolio if we would need to rebalance. That's a key risk management tool that we use in these volatile time periods. That's really the story as it relates to performance. I want to make sure answer any questions before I pass to Amanda, or we kind of switch gears and I preview the alternatives discussion as well.
I don't think there's any question about the volatility in the market and where it's at. I mean, I think everybody hears it and feels it, and that's why I think we can feel comfortable and confident that we do have a strategy and plan that looks long-term. This is a forever investment. And when you look at through June 30th, it was down 15% for the year roughly, and it's already up to -9%. I
Yep.
mean, it tells you how that can change. And of course, with the dollars involved, that's a substantial amount of money. But I don't think it should be a surprise to any of us, and it's not an easy thing to see. But as you look at the foundation from its inception, which was back in 2016, and reminding everybody, prior to the foundation being set up, it was less than 1% that we'd earn on those funds. And in light of all of what we've seen, and we've had some great years, and some really great years, I know we've had some trying times, especially the last year and a half, but still, if I'm reading this right, it's showing a 5.16% increase or earnings since inception. And that's something I think we should feel pretty good about.
And that's the annualized.
Yeah, that's annualized, so that corresponds to over $50 million in gains since that 2016 inception.
And does that number include the money that we've taken out?
Yes, that would be net of that too.
Yeah, so what I said was just investment gains only. Yeah.
So, yeah.
Okay, well, if we want to switch gears and flip behind tab 1, and then we would go to the other PDF within that was on the file there. So just as a reminder, on page 2, at the last meeting, I quickly previewed some work we were doing, or due diligence we've been doing within the alternative space. Alternatives are currently not part of the Porter County portfolio. As you recall, we have 55% allocated to equity and 45% allocated to fixed income. And so that 55% equity allocation, that's the big important number, because per statute, that is the limit that we can strategically invest in equities. So all of the analysis that we've included today in terms of a maybe potential allocation of alternatives keeps that 55% limit in mind. And so really these next pages that Amanda will cover are a preview into alternatives. We're not necessarily looking to make any decisions today, but we have some ideas that might benefit your portfolio long term.
Okay, thanks, Corey. So everyone on this board has always been open to education on the portfolio, and that's the lens in which we're viewing this discussion tonight. Your outcomes tonight could be to tell us, we don't want to talk about that anymore, or we want to think about it, or, yeah, we want to move forward with that, just so you kind of know going into it. Obviously, you have discretion as a board over the asset allocation. So on page 3, let me just remind you kind of what alternatives are. There's no kind of perfect industry definition, but the way we think about alternatives are they can either be an asset class in and of themselves, like real estate or commodities. Those are alternative asset classes. Or they can be normal, traditional assets traded differently. So they could be equities or fixed income, but shorted or traded differently. So that's a broad definition of what we mean by alternatives. Right now, you have no exposure to alternatives. Many foundations do. So we feel like it's our duty to kind of bring this education to you for your consideration. So why would you use alternatives? Well, it depends on what type you would use. But what we're kind of putting in front of you, you would be implementing alternatives for ideally enhanced return and improved risk through diversification. So the idea would be that by introducing asset classes that you don't currently have exposure to, you could kind of smooth the ride over time and introduce diversification. But the reasons you might decide that this isn't for you could be things like the lower liquidity characteristics of alternatives, the higher fees, the fact that there's more complexity. So there are pros and cons to introducing alternatives, and we wanted to just be transparent in that kind of, description to you. So on page 4, I'm not going to cover this in depth. This is mainly just to show you what your asset allocation could look like. So through this presentation, we're just going to talk about a potential 20% allocation to alternatives. We would source that from both fixed income and equity, such that at the end of this, you still have the appropriate amount in equity. And what you have to understand is these strategies, while they're called alternatives, they still have equities in them. So we would still be looking through to that underlying equity exposure so that when you add it all up, plus your traditional equity, you still fall within that 55% range. But this is just showing you that we'd have basically an allocation to the right there of 44% to equity, then 20% at the bottom to alts, and then the remainder would be in fixed income and cash. On page 5, this is just an illustration, and there are all kinds of illustrations like this out there, but to show you that there's all different types of alternatives, everything from liquid alternatives that you can get through a mutual fund to things like private equity with 13-year lockups, and everything in between, like hedge funds that you've probably heard of, real assets, real estate, commodities, etc. If we were to just kind of draw a circle on what we're showing you today, it's that orange circle in terms of where it fits on a complexity and liquidity spectrum. So kind of closer to being liquid than something like private equity. This is just to kind of show you where what we're talking about today falls. On page 6, we have a structure for you to consider. And again, we know this is high level at this point. We could go into a lot of detail on this, and there's a whole lot of detail in the back. But if we were looking at this, which we are, with you, we would kind of, I guess, from a clean sheet of paper perspective, we'd think about what should an alternatives allocation include. We'd want it to include some level of growth, because you still need it to give you return. We'd want it to have some level of preservation or income, because the structure in and of itself still needs to be balanced. And we'd also want there to be some sort of real return or real asset exposure to help offset inflation and have that component to it. So we have a 3-piece kind of structure here, and then we have 3 funds that fall into each of those categories that I just outlined. The reason that we've got the orange part of the pie, the fixed income or preservation portion, kind of more heavily weighted is, again, so that we can keep underneath that 55% equity limit. So we're kind of overweighting the preservation piece, because the appreciation piece is actually equity, but it's different types of equity, which I'll talk about really briefly. And then the real return is also equity. So I'll describe that in a second. So again, the goal of something like this would be to reduce overall portfolio risk, add diversification, particularly away from fixed income, which has so many headwinds right now, but then also kind of provide you just a more diversified and risk-averse portfolio going forward. On page 7, there's a lot of detail here. I know I'm trying to kind of give you the high-level preview. On page 7, we have detail on each of these 3 funds. I'll go through each one of these kind of briefly, but first and foremost, I want to tell you that these are all institutional level funds. And what I mean by that is these are the types of funds that the largest foundations and pension plans in the country are investing in. These are not retail funds. You couldn't go out and any of us could buy these individually. That's one of the reasons we're excited about these funds, is because some doors have opened to allow some of our foundations to get into these share classes. And what I mean by that, let me give you an example. One of our clients is a large state pension fund, and close to $800 million in size. They have allocations to these funds. While we have no relationship with any of these managers whatsoever, these managers recognize that we have other clients. And they've told us that since you've got this one client who's in these funds, if you have other clients, we would let you access these highly institutional share classes. So an example of that, just to kind of make it more clear, the North Rock Fund on the left has a minimum of $150 million. Meaning for you to even be an investor in this fund, that's the size of check you'd have to implement with them. They're willing to waive that. That's an example of where we have no relationship, we don't get anything out of this, but they're saying, hey, Capital Cities, since we're just working with you, we're happy to waive that. And the result is that you can get a truly institutional long-short equity fund for 1.5% management fee, which is that's higher than what you pay now for anything, but that's very strong. So that's just an example of why we're excited about these funds. But let me just quickly kind of talk about each one of them. The Lighthouse North Rock Equity Fund on the left is a long-short equity fund. So that's very different than what's in your portfolio now. The underlying stocks in that portfolio, some of them are bought long, some of them are sold short. That means that it's truly alternative, and that there could be times where a stock price falls and you would make money on that fund if the stock was shorted. So it's very different. Again, we could go into lots more detail on this. I'm just brushing the surface here on this. The next fund in the middle is the Lazard Global Listed Infrastructure Fund. This is a 100% long-only equity fund. So this is the most kind of plain vanilla of the three on this page. It is just a mutual fund. It is daily liquid. But the reason we think it could have a place in this portfolio is that Lazard is only buying the stocks of infrastructure-related companies. So they're buying stocks of utilities, satellites, toll roads, all of those types of companies who can pass on inflation directly to their consumers, unfortunately, which is us. But the idea there is that stock fund will kind of tend to do well when inflation is going up. And then finally, the Cliffwater Corporate Lending Fund. This is, in a sense, fixed income, but nothing like what's in your portfolio. This is a portfolio of underlying private debt that Cliffwater is working with other managers who are making private loans to middle market companies. They're earning 8 to 10 to 12% on these loans, and these are floating rate loans so that as interest rates go up, the interest rates go up. This is completely different than, like I said, the other fixed income in your portfolio, and that's why it could be diversifying, but it's also considerably more complex. So that's just a snapshot of the three funds. On page 8, I'm going to be real careful of time here. While I guess when we're thinking about, how can we show that these could have been additive, or that, that these are doing the role that we think they could do, we can do back testing. That's not to say your portfolio was broken in the past, but we can show you what did these funds look like compared to your portfolio that you're actually in now. So on the left side of the page there, this is a scatter chart, and you'll just have to bear with me to kind of give you the high-level view of this. We're basically showing returns on the vertical axis, risk or standard deviation on the horizontal. So the closer you are to the top left of the page, the less risk you're showing, but the closer you are to the top, the higher you are on the page, the more returns. So the point of this is to show you that this bucket of alternatives, the orange circle, has had similar returns, slightly higher over time than your portfolio with less risk. That's just, it's neither good nor bad. It's just showing you, yes, this would have had decent returns with less risk. The chart on the right takes a little bit of explanation, but it's a beta chart. So beta is a measure of correlation, and you can measure correlation to anything. So in other words, how does one thing move relative to another? The way you can prove whether something would have been diversifying is to show that it has a low beta. So the simple way to explain the chart on the right of the page is just to show that orange line has considerably lower beta than the blue line, which is your portfolio, meaning it would have just been diversifying. Sometimes that's good, sometimes that's bad, but nonetheless, it would have been a diversifier. So page 9, I'm not going to go through this. It's more detail on what's actually in these funds. And, you know, we've done on-site due diligence visits at 2 of the 3 funds, the Lighthouse Fund and the Cliffwater Fund. So we could talk at length about these funds, their strategies, their teams, their corporations, kind of how they do business. But this is just a snapshot for you. On page 10, I think it's really important that you understand some of the operational considerations. If this were easy, everyone would be doing it without any discussion. But these types of assets are more complex. Anytime you introduce something, you know, that's not a daily traded mutual fund, you're bringing with it higher complexity. So we've gone through some of those things. From an implementation or just investing in it perspective, it's relatively easy because these funds are both, let me back up. The Lazard Fund is a mutual fund, so I'm not going to talk about that. That's very easy. You already have mutual funds, so I'm not going to talk about that one. Cliffwater and North Rock, something that is beneficial is that they're both accepted at Schwab, your custodian, so that helps a lot. But like for North Rock, for instance, you would still have to sign pretty extensive subscription documents. You'd have to submit articles of incorporation. There's know your client rules. They'd want driver's licenses and things like that. So just want you to know about that. From a liquidity perspective, these are all liquid, but not on a daily basis. So Cliffwater has quarterly liquidity. North Rock has monthly liquidity, but you have to tell them 90 days ahead of time that you're going to want it. So there's, you know, it requires a little bit of effort in terms of liquidity. Of course, these are in a portion of your portfolio that we would never expect to use for liquidity, but I would still want you to know that. And then from an audit perspective, I don't sense that there would be any issues because, you know, these funds have a lot of institutional investors and go through with this all the time, but we're just recognizing that you might have to sort of report that these funds are not daily liquid. So, okay, 526, we're doing, or I'm sorry, 526. So we have a whole lot more information in here. We have performance charts. We have pitch books on each of these funds. We can kind of go into any level of detail you'd like. We could do this in a separate meeting, or you could say, this just isn't for us. Thanks for the info. So let me pause there.
Just a real quick question. So I assume you're presenting these because this is what you guys are recommending we do, or are you just giving us options?
Well, if there were no operational complexities, we would recommend it in a heartbeat from a risk-return standpoint. Absolutely. I would put these in my 401k if I could. We definitely have that level of confidence in these funds, but this is a pretty big change from where you started at much less than 55% equity on the complexity front. So that makes it a decision that you have to sort of come to a consensus on.
You answered my question, thank you.
Okay.
I just hearing about it tonight, so I got to digest it a little bit. I don't know
Yeah,
about
that's very fair.
We asked them, they brought it up last meeting, and we asked them to bring it back.
No, I wasn't surprised by it, I was just saying I didn't, first time seeing it.
Anybody else have any questions while they're here, or comments, or?
The one where there's short, it almost seems like now would be, the market is dipping. That would be, seems like that would be one that would be favorable at this moment, right?
Well, that's certainly an easy way to think about it, but we would recommend this for the long haul because basically that fund is made up of 40 to 50 underlying long-short managers who are each highly specialized in one sector. So there might be one manager who does nothing but buy and sell telecom stocks day in and day out. So in that sense, it almost removes the market from the equation because, yeah, maybe the market looks bad in general, but maybe this one stock looks better than this one. And maybe they'll then buy this one and sell this one short. So the goal is actually to remove market directionality from the equation And that's one of the key reasons to recommend something like this, is not make a call on the market, but hire managers who can do well regardless of what the market's doing.
Does everybody understand a short sale?
I watched a movie about it, it was really good.
Just making sure.
No, I'm just joking about it, yeah, I do.
So what do you think? Do you want to spend some time looking it over? Do you want to move on it? Do you want to?
Yeah, I would
I would
think
like to.
that there's a lot of information which we ask for and we appreciate.
Absolutely.
But a lot to consider and think about, and certainly would like to get some input from the advisory board members too, who unfortunately aren't here tonight, but I would think they'd add some level of expertise and knowledge that'll help provide some additional direction for us. But
That makes sense.
Sure,
appreciate the
Vicki would like to look into the audit details.
The reporting issues.
Yep, like with reporting, they are on Schwab, so that's one of the reasons we felt comfortable putting this in front of you at all, because we have clients in these funds, and there's a lag of reporting, but it's not a 90-day lag. It's, weeks lag compared to some other alternatives.
So they would be included in the Schwab monthly reports? Okay.
Yep,
Oh, that's nice.
yes.
Vicky digs it. Are the fees extremely large when you said they're bigger?
Yeah, we did a quick kind of calculation on fees. So the weighted average fees of that group of three is 1.42%, so 142 basis points. Your current weighted average fee of your entire manager lineup is 46 basis points, or 0.46, or just shy of 0.5%. So by adding a 20% allocation to that 142 basis point group with 65?
It's 65.
60, your overall fees would go to a weighted average 65 basis points. That is still very reasonable in the realm of what other foundations and endowments are doing, but it's a marked increase. Now, all of the performance charts in the back, if you come across this when you're looking at it later, they're all net of fees.
Okay.
So we still think that, we wouldn't bring this to you if we didn't think it could be additive, even with that slightly higher fee.
I figured, I just wanted to ask.
Yeah, definitely, that's a great question, thank you. I meant to say that earlier.
So what would your recommendation be of moving to alternatives? How much of our,
So here we're showing you 20%.
what?
We could arrive at any iteration of that. I would say you'd want to look at least 10% to make it worth your while from just, if you're not going to do 10%, then you don't want to spend the effort on the oversight of it. So I'd say I wouldn't go over 20 though. So between 10 and 20
Is that 10 or 20 of the 55?
of the total.
Of the
Oh,
total?
the
Of the total.
Okay.
And we'd also have to overweight that Cliffwater fund to keep the equity number in check with the statutory code.
And you had the pie chart of that.
Yep.
Yeah.
Okay, everybody want to spend some time looking this over, and
Okay, we'll check back in.
we can email you questions?
Sure, that'd be great.
Okay.
Well, we
Thank you for the
definitely.
details.
Yeah, we appreciated the opportunity to kind of share this info with you,
It's
and
much appreciated.
open to any questions or any future discussion for
We
sure.
like making more money.
Let's set the time for the next meeting before you take off.
but just to finalize, your recommendation is to move forward with us moving into some alternative?
Same thing I said to Andy, on a risk return standpoint, absolutely. But if this isn't within your risk tolerance or your operational complexity tolerance, that's a question you have to answer as a unique organization.
All right.
All right, when shall we meet next? Do you want to wait 3 months, or do you want to look at this and meet sooner?
I'd like to meet sooner, just so we can move on it. I mean, if we want to move on it.
Can we still do that with our schedule? Does that work out with?
Yeah.
Okay,
You have to have one in the fourth quarter, so
okay, so that'd be fine.
that'd be fine.
So September, October, what do you guys think?
You want to do it before a council meeting as normal, or does that work for
That
you?
works fine for me.
You tell us.
I don't know
I'm
what
open
your
either one.
budget schedule is, so.
I don't think we finalized it yet.
We've got the dates out there, yeah.
Yeah, suggested.
Not in front of me, but, I mean, yeah.
And to be clear, if we're trying to do the fourth, we'd have to get to October for it to count for the fourth
All
quarter.
right, well, let's get to October then. How about October 24th, or 25th, excuse me?
Sounds good.
We will,
Are you guys open?
we have a client meeting out of state,
Okay.
sorry.
Oh, we'll do it without you.
Okay.
Budget meetings?
Yeah, let me try to look.
18th is a council budget meeting.
Do you have the 18th available?
I didn't know we had a budget meeting that night.
Yes.
I
Yeah,
asked for final, because it's
that
the
would be
final
great,
schedule.
actually.
October
I
18th?
was afraid.
All right.
So what time? 5?
Do you start at 5 or do you don't have that nailed down yet?
No, we're at 5:30.
Okay, 5 o'clock Central
5 p.m.?
Time, October 18th.
Okay.
Hey,
October 18th.
Sounds good.
thank you all.
Thank you.
Thank you very
Hey,
much, thank you.
Enjoy, will you let our
Safe travels.
advisory people know right away? Thank you. Okay, we have next the attorney report.
I have nothing.
And any other matter? We've got approval of claims, Capital City for the third quarter, July 1st to September 30th. $16,250. Do I have a motion?
Move to approve.
Second.
Motion and a second. All those in favor signify by saying aye. Aye. Opposed, same sign. Motion carries. Is there anyone who would like to address this board?
Yeah, pension stuff. Hey, Paul always walks into our
Meeting is
meetings.
adjourned.
Shriner.
Just to let the foundation board know that the audit of the 2021 foundation statements is beginning,
Awesome.
separate from the county audit. So we're just having fun going through
Fun and games.
lots of audits.
Yeah, I gotta get one of those too. I'm gonna go with Commissioner Blaney and secret member.
Thanks.
I see.
You got a secret one, right?
Roll that way, or?
Motion to adjourn.
Make a motion